All right, oil prices rebounding slightly this morning after yesterday's steep decline. You can see right now WTI is up by about 1.3%, back to 68.27. Brent's at 72.35. For more on what's been happening with oil prices and what you can expect next, we want to bring in Daan Struyven, who is Goldman Sachs co-head of Global Commodities Research. And I'm sorry, it's Struyven. Don, let's talk a little bit about what happened yesterday. We saw Israel counterstrike on Iran. It did not include some of those oil facilities that had been anticipated, maybe what drove prices up. Is this a good reflection of where you think prices should be at this point?
Yeah, thanks for having me. So I think indeed the sharp sell-off yesterday, which was actually the biggest daily move since 2022, really reflected that oil assets and nuclear assets were spared, that the U.S. got a advance notification, and that the response from Iran's supreme leader was quite measured. From here, we see some modest upside risk to oil prices. We have Brent in the high 70s, mid to high 70s for the remainder of the year.
You think prices come down from here?
In the short term, we think the most likely direction of travel for oil prices is higher. Number one, valuation and positioning are both in the bottom 10% of the historical distribution, in sharp contrast with equities or credit, for that matter. Second, at these very, fairly low price levels compared to fundamentals, we think sort of $8 per barrel too cheap relative to the level of inventories. We see demand from the US SPR, from airlines who buy cheaper oil in advance. And finally, at this point, the geopolitical risk premium is very, very small. So I think the risks are, in the short term, skewed somewhat to the upside. That said, looking out further, the market is already very focused on the risks of oversupply in 2025.
Sure. So let me talk through and take the other side of some of those arguments you just brought up. First of all, geopolitical risk potentially down, but there's a chance that Israel could come back with a second strike after the U.S. election, particularly depending on how that election is decided.
Yes, so at a very high level, I think that geopolitical uncertainty remains quite elevated. You have the U.S. elections. The conflict in the Middle East doesn't seem fully resolved. And oil markets at this point are only pricing in a very small probability of disruptions. And you don't necessarily need to see physical disruptions to see a tightening in Middle Eastern oil supply. You could also have a tightening in the enforcement of sanctions. One key fact is that over the last 2 years, supply from Iran has risen by about 1 million barrels per day. That's about 1% of the global market. That could potentially reverse if Western sanctions are tightened more, are enforced more strictly.
Yeah, I think looking at the supply-demand picture, there are a lot of questions. Supply seems like it's pretty abundant at this point. Russian oil hasn't shut down. Iranian oil hasn't shut down. U.S. producers are going. And as you mentioned, depending on what happens with this election, we'll see if U.S. oil production rises next year. But it's already at pretty high levels. And there are questions about what happens with the economy. If the economy turns down and demand weakens, whether that be here in the United States or globally, how much of a fine point are we on? Where could prices go, let's say, on the downside or the upside?
Yeah, so I think if I look at 2025, we have a Brent range of 70 to 85, base case mid-70s. I do think the risks are moderately skewed.
That's for Brent.
For Brent, yeah. Subtract $5 for TI, yeah. Base case around 70, a touch higher than we are now. But I do think the risks are skewed somewhat to the downside, especially if you go out further into next year. The possibility that OPEC brings more barrels back than our base case. The possibility of potentially a weaker global economy if trade tensions were to escalate. So I'd say medium-term downside to sort of the $70 TI midpoint of our forecast. And to put some numbers on it, if OPEC brings barrels back for 12 months, then our model suggests that Brent would end up in the low 60s. Wow. As opposed to our base case of mid-70s. In the short term, however, I do see some upside risk. Actually, if you look at fundamentals, over the last 2 years, if you zoom out, global oil stock levels have been pretty much flat. But over the last 3 to 4 months, you have seen some tightening. China demand is finally picking up. Sure. U.S. supply growth is moderating. And so I think tactically we're constructive. But if you look out to 25, especially the second half of 25, we see risk skewed to the downside. Okay.